All right, everybody. So thank you for checking out the Private Lender Playbook resources page. So I have another interview here for our interview series with the Private Lender interview series with a good friend, John Gowan. John, how are you doing?
Doing well. Good to see you again, Brant. And thank you.
It's been since we've seen each other face to face, so to speak. Yeah. But we talked a little, you hopped on here, we record button. It's just a real, just honest conversation, just kind of letting a little bit about you, but also of how you found out about private lending, what's your experience, any pros, cons, what you like, anything you don't like, and just any advice you have for people who are kind of kicking tires, so to speak, and thinking about investing as a private lender. So why don't you tell everyone a little bit about yourself and so they get to know you, and then we'll move into some lending type of questions.
Yeah, absolutely. So I guess first and foremost, I'll say I'm a Christ and a fan. I got two beautiful daughters, been married for a little over 20 years, and it's been fantastic. On the career side, I got my degree in aerospace engineering, started with NASA Johnson Space Center right after, so worked at NASA for over 20 years. And kind of had a little bit of a side hobby or career going as well. More on the investing side. Investing and investing are my two passion areas. And even back in 2002, 2005 timeframe, really got plugged into public markets, typical stuff people invest in, bonds, mutual funds. Got so passionate through doing Dave Ramsey and other things with finance. I had to become a registered investment advisor in 2007. So just kind of doing all that stuff on the side from my NASA. Then 2008, I'd always wanted to do real estate, but had a lot of exposure. So joined Lifestyles Unlimited here in Houston, single family and multifamily investment opportunities. And that's when I met you, Brent. You were started a contractor company at the time, and I was doing my first rental, and you came in and did a beautiful job fixing it up. And
what year was that?
I think that was like 2009, 2010. Yeah.
Oh, yeah. That was the first year, was midway till into 2009. That's when we started.
Yeah. So with you was
remember it was over by Webster. Is that correct?
Yeah. So I live in the Clear Lake area, was down kind of the Dickinson League area, and so that turned out to be a real good deal. In fact, I would bought up a whole lot more back in there. But that was my kind of first into real estate. So I seeing multifamily deals, and on the multifamily side, I'd like the single family homes, deal with tenants and all that kind of stuff. And it was still good investment, but at somewhat time at NASA, it was getting to be a lot of demand. I was up to 4 rental properties, and I know that's a small portfolio compared to what you've managed in the past, but
I wasn't working at NASA though.
But it was a lot to keep up with. So was always kind of looking for more of that passive income. And so I heard you were doing private lending, and I think it was early on private lending, 2013, when I think I had my first private loan with you, and saw that get 8% or more on my money with really out having the finger. And I knew enough own deals of doing single family of how you evaluated what a property's worth and what's going to take to pour into it, and the value ratio that's reasonable, but having the money for you to go out and either flip the property or turn it into a rental. And for me, kind of get a nice return, 1 year balloon payment, and kind of quick get my money back, and being able to have that flexibility to either do a subsequent loan or then, depending on what's going in the public markets or other opportunities I'm seeing, being able to pivot and do what I want with that capital. So like the flexibility for something that I felt was relatively low risk, because it's backed by real estate and you're buying it at a discount and you know what you're doing and all those sorts of things. I felt like it was a good way to kind of balance a portfolio of doing other things, which now kind of spans the whole spectrum. I left NASA a year ago, and now I'm doing a lot of investing full time, but more on the space side. So doing some venture capital, and I'm working with investment, all those sorts of stuff on more of the professional investment side. But I think real estate on that risk return profile is pretty attractive when you look at the returns you can get compared to the risk that you're taking compared to some other asset classes.
Yeah. And it doesn't have to be someone's only investment, like you mentioned, just, a percentage of your portfolio, use it where it makes sense. You kind of touched on this, but do you have any advice for someone just getting started, thinking about this? Like, what advice would you give, like, for a lender, for big things, for your feasibility checklist, if you will?
Yeah, I mean, I think for your first time to know a little bit about states in the industry and just some of the terminology, what do we mean by loan to value? What do we mean by after return value? Knowing how someone like you evaluates deals in terms of finding comp and taking those comps and really being strategic about that and making sure that it's a good investment from the borrower's perspective, right? Because as a lender, you're kind of underwriting the deal, not nearly the degree a bank would, but at least need to kind of know about the industry and real estate to some extent, kind of know the way to and know a good deal. And then I think, really investing with someone and trust, I think is important. Being able to look someone in the eye, kind of understand their background. I mean, whether it's real estate or any other investment, I'm always looking at track record and first, making sure that they're an honorable person. But so just kind of looking at that person's track record, investing with you. I knew you had the background in terms of and rehabbing is huge because you can kind of go into being able to quickly evaluate a property and say, it's going to need X number of dollars and be pretty spot estimates. And knowing, if you X and you pour Y into it, hey, I need this in terms of my return, and sure the comps support that. So I like that about your background. But then over the years, you were just in payments and your ability to pay off those loans without defaults, without being late. And it's not just me, you built out the whole portfolio where like now 10, 15 years later, I have a great track record with me, but you have a great track record with all your investors where I don't think you've ever defaulted on a payment. So
knock on wood.
Yeah. And
it hasn't always been easy, but
I know.
I've kept that.
Well, no, I'll say too, right? And that's the nice thing about having these relationships too, is I felt like I could always call you up on you'd be honest with me. And, we went through times like COVID where I think there was a lot of uncertainty, and I remember having a conversation with you early in COVID, and like, I don't know, this is a pandemic we've been through in our lifetime, so it could result in some interesting situations from an economic perspective or a real estate market perspective, and we talked through that. We had an honest conversation, and I felt good going out of that. So that's why I think having these personal relationships matter.
Yeah. So let me ask you the background and in investing, and now you're working with investment fund structure, and you've also invested in a couple of the syndications that we did on the land deals, and those speak of some of uncertainty, along with us through this ride where things didn't work out at the end on those lands. Now they're working out well, but it was a little valley that we had to go through. So what is your insights or just advice or wisdom to people that are like, hey, should I invest with one lender, one lien on a deal, or should they look at syndications? Like, what's your perspective on that?
Yeah, I mean, I diversify a little bit where I'm going to do some private loans on some single family homes that I feel like are a little lower risk. Some of the syndicate deals, actually developments I've found have been the riskier end of the spectrum. And it's not just for you. I've invested in some ground up development deals through other syndications that I'm still waiting to get payoffs. I mean, I think they're going to pay off. I think it's going to be use money on a real estate deal. I'll say that. But ground up development deals that, let's just say, it's real estate. What can go wrong? So sometimes will go wrong in terms of construction and permitting sorts of things. And you've got experience, so you've been to navigate that, and that's been great. But I think it's all about making sure you're buying it right when you're doing those little bit riskier deal, raw land and developments. I felt comfortable with the deals that you mentioned, Prairie Landing and Ridge, because you were buying it at such a discount. And I felt like the risk of losing principal, which is kind of first and foremost, right, was pretty low. And it took longer to get my money back or didn't quite get the return I was hoping for. That was okay. But like you said, it's now turning out to the point where I'm getting what I thought that it was going to pan out, right? And you had to pivot a little bit, right? I think instead of doing some development yourself, which I think was the right pivots, and I think that's the flexible in this industry as well.
Yeah. No, I think you kind of hit the nail on the head. In my opinion, is the private lender playbook is geared towards giving people something that should be a low risk with a fairly predictable return.
Right.
If you're keeping it single family, something that almost everybody understands. But the syndication route, and we touch on it a little bit in the book, just lightly, it is a different animal. And so I definitely spend time on their research and feasibility
Due
on
diligence.
that, because that risk quotient is usually going way up on development deals. And yeah, that risk is just, and anytime you're prolonging investment, there's more risk. The longer that timeline stretches out, there's just going to be more risk, more uncertainty. We're going, at the time of this recording, and there's just things going on in the world. That's why for most people, one lender, one lien, single family deal, safe LTV is the way to go for most folks, but diversify. Certain opportunities will come along and you pick your spots.
Yeah. And I'll just add one other thing on risk too. There's another type of risk that I'm having to educate my parents on, and I'm probably going to get them in touch with you at some point, Sue Brand, because having this conversation with them just the other day, and my dad's 82, mom's in their late 70s, and they need some income producing assets for the last 10 to 20 years of their life. And, they're scared to death of the stock market, and I wouldn't necessarily recommend at their age they put a lot of money. Investment advice here, right? It's disclaimer there, but I will say, I was telling them that the 3.3% that they're earning even though that seems safe, it's risky in the sense that they're going to be overcome by inflation, and they're not too much at risk about living their money. But it's one of those deals where I just feel like they have to take some risk above the CD or the treasury bond level to get the 7-8+% return. But like this with real estate, it's backed by a physical asset. You're buying at a discount. You're investing in someone who, if I'm investing with you, has never defaulted doing this. And you look at other asset classes, and I'm not sure you can get that same risk reward profile. So I'm trying to educate them on that. And I think that's just an important piece, because everyone wants to focus on risk of losing your capital, but people don't like to think about the other risks associated with keeping up with them and all those sorts of things.
Yeah, I had to have a similar conversation with my parents and my in-laws. When they retired, rolled some money over IRA. Both of them did, and not a lot, but they're counting on that money to be there when they need it. And, they couldn't lend me because it's a prohibited transaction. So I had to go through that process, and it took a while, even though as long as I've been doing it. And then, so ultimately, they didn't want money coming in, money going out in terms of like their principal coming back. So ultimately, they did land on a long-term syndication type fund structure. And that's worked out well, but I know the syndicator very, very well for almost 18 years since I've been in business. So I kind of steered them in that direction, and it's worked out well. And I will tell you, though, there was a couple of other individuals that I knew very well and trusted. And I said, hey, I'm not going to pick one. I'm like, I want y'all to meet with all three of them, and I would endorse them. Well, as we know, one of them went a little bit more heavy on the commercial side and was going through really, really difficult times. So thankfully, my parents went with what was my strongest recommendation. You just never know, but it is important to, like you said, do deep dive on feasibility and getting it, try to, as safe, secure, and predictable as it can be. Well, I know you have got a hard stop. You got some other get to. So John, I just want to thank you for coming on and those insights. I think that's going to be really, really valuable for watching this. So I really, really appreciate it.
That's my pleasure. I've always enjoyed working with you in different capacities, and you've been kind of a good mentor on the real estate side as well. And so happy to have this conversation, and it's great talking to you, Brent.
Yeah. Thank you very much, John.